The economy is about to enter a recession, and the data shows it could be here as soon as 2 months. I'm your host, Steven Van Metre, and thanks for joining me today as 2021 ended with strong numbers, giving many people the confidence the economy is about to roar this year. But the early data already shows, and many experts are confirming, that we're about to enter a contraction at the end of the first quarter, and that's a signal for a recession. And to make matters worse, even the Fed's on board with that. Let's start out with the good news, and then we'll get right into the data so you can see just how close we might be to a recession. Here we go to the Wall Street Journal that headlines the U.S. economy grows as fourth quarter GDP shows strongest year in decades. And economists expect the growth to slow this year on weaker consumer spending, persistent supply shortages. And this is really going to be a story of a lack of fiscal stimulus. Gross domestic product, the broadest measure of goods and services in the fourth quarter, accelerated from the third quarter's growth to 2.3%, adjusted for inflation. The Commerce Department said on Thursday. The gain reflected solid spending by households, much of it occurring early in the quarter, and companies pushed to rebuild depleted inventories as they try to overcome persistent supply shortage. And I want to emphasize the early quarter because what happened in the fourth quarter of last year? Well, the extended unemployment benefits ended, and while at the end of the quarter, the child tax credits also ended, and with that, all the fiscal stimulus. So again, this is really a story that demand is going to go away. But notice, the paper says it's a supply issue. Well, I don't think we agree with that, but let's keep going because Thursday's report contained warning signs. Most of the growth owed to companies restocking rather than people and firms buying stuff. Again, that would suggest a demand issue. In part, the rise in inventory investment reflected a rebound from super low inventory levels in the summer. Inventory levels remain low because of persistent shortages, excluding the inventory effect. Output grew at a modest annual rate of 1.9% in the fourth quarter. And so this is something to understand is the GDP number also factors inventory building. So when there's a lot of inventory growth, well, you can get a big GDP number. But if there's no sales behind it, well, you kind of know where this story is going. Let's keep going because Americans reined in shopping toward the end of the quarter. Not a real surprise with the lack of fiscal stimulus, according to other Commerce Department data on retail sales, as the Omicron variant of COVID-19 triggered a new wave of infections and higher prices cut into their paychecks, which we're going to look at shortly. A separate Commerce Department report Thursday showed sales of durable goods, long-lasting items such as cars, refrigerators, and bulldozers all fell in December. Two factors that helped drive last year's expansion: a torrent of cash sent from Congress to households, as I've been pointing out, the fiscal stimulus, and ultra-low borrowing costs stoked by the Federal Reserve's loose monetary policies are fading. Households have spent down some of the stimulus money, actually most of it, and the Fed has reaffirmed this week its intention to raise interest rates as early as March to combat a sharp rise in inflation, which has damaged consumer confidence and outpaced a growth in workers' wages. And sure enough, they're right. Here we take the average hourly earnings of employees and reduce them by the Consumer Price Index to see what are called real or inflation-adjusted average hourly earnings. Well, they're negative. And well, you don't only see that during recessions. And so what that's telling you is that consumers cannot afford higher prices. Despite wage increases, prices are rising faster. And that's not good if you're thinking about an economic growth. What it does tell you is the more probable outcome is a slowing or contracting economy. But we've got a lot more data, so let's keep going. Because the article goes on to say the path of the economy continues to depend on the course of the virus, the Fed said in a written statement this week. Progress on vaccinations and easing supply constraints are expected to support continued gains in economic activity and employment, as well as reduction in inflation. Risks to economic output remain, including from new variants of the virus. And so the story from the government is this is all about the pandemic. But really, I think it's more of a story about a lack of fiscal stimulus and demand. Because if they're right, well, then all those inventories should be going down as the pandemic goes away. And if I'm right, it has no bearing. Those inventory levels are only getting bigger. But let's keep going because the biggest challenge for the economy right now is demand. But it's not demand, but supply. The article says, well, I think we can safely disagree with that. And let's head over to this article from Zero Hedge that says recession on deck as B of A slashes GDP forecast sees significant risk of negative growth quarter. And if you're concerned about what that could mean to your portfolio, and you might be seeing that from the stock market now, well, you don't have to be. Check out Portfolio Shield. You'd be glad you did. And there's also a link in the description below. Let's keep going because while not yet a recession today, Bank of America stunned the market when the chief economist joined JP Morgan in slashing his GDP for 2022, especially for Q1, where he said his forecast has collapsed from 4% to previously just to 1%. That might be optimistic. A number which we are confident will drop from zero and soon negative if the slide in stock accelerates due to the impact of financial conditions and the lack of wealth effect on the broader economy. And there's a lot of truth to that statement that the stock market has a big key to consumer spending. But we'll talk about that in another show. But let's keep going because how does the Fed hike up a storm at a time when B of A admits risk are growing for a negative GDP quarter in Q1? Well, as Harris admits, a new call raises a number of questions, and one of them they asked was about an inverted yield curve. And let's go to a bigger chart of this and suggesting that there is a problem because what we're seeing here is the 30-year Treasury yield minus the 5-year Treasury yield, and what that's looking at is the gap between the two. And what I want you to understand here is that yields are a function of growth and inflation expectations. So on the front end of the curve, the shorter yields, 2s, 3s, and 5s, well, what it's telling you is, well, there's growth now and there's inflation now, but what is the 30 telling you? Well, when you look far out into the future, it's saying, well, we don't see a lot of growth and inflation, so little that 30-year yields are suggesting that growth and inflation is likely peaking out where we're at now. And that's what we see here. And if you see 30-year yields fall below 5s, or if it gets that bad, well, it's telling you the future growth and inflation expectations are significantly worse. Let's keep going because even the Federal Reserve Bank of Atlanta jumps in on this with their GDP Now forecast that just came out, and the latest estimate shows 0.1%. The initial GDP Now model estimate for real GDP growth on a seasonally adjusted annual rate in the first quarter of 2022 is 0.1% on January 28. That means they are predicting right now at the end of the quarter that growth will be 0. And just so you know, the Atlanta Fed generally overestimates the actual print, suggesting the economy is heading into contraction and the beginning of a recession. Let's keep going on because the U.S. labor costs grew at the fastest pace in 2 decades as inflation picked up. And a sign of potentially good news, employers are raising wages. Employers spent more than 4% on compensation last year amid a tight labor market. And it appears that labor costs are actually accelerating at a much faster pace, and firms have already demonstrated that in aggregate, they have significant pricing power to pass those rising costs along to their customers. Well, Stephen Stanley, I'm not sure, even though you're the chief economist at Amherst Pierpont, I'm not sure I agree with that view at all because real wages, Stanley, are headed down and doesn't mean they can pass those prices on at all. But nevertheless, let's continue on because here you can see the non-farm business sector unit labor cost for all employed persons in blue is rising. And what's interesting is we've got that charted over the consumer price index. So as consumer prices rise, well, what happens? Employers are forced to raise wages. And so that kind of feeds upon itself until, of course, something breaks. And of course, what breaks is those higher prices actually grow faster than wages, and that cuts into demand. And then all of a sudden, employers are stuck with higher price employees and a lack of demand, and then you get a turn in the economy. And it's important to understand because the next chart tells us that even though employers are seemingly desperate for employees, well, they're not getting a lot of productivity out of them, and that's also a sign of an incoming recession. Let's check this out because here you see non-farm business sector labor productivity or output per hour for all employed persons in blue. It is contracting, suggesting that employers are not getting much for their increased wages and new hires. Meanwhile, inflation runs out of control, and what you see is when these two are at polar extremes, well, usually you're coming out of or near a recession, further validating the situation is grim coming into the first quarter and suggests we will actually be in a recession sometime by the second quarter, even as the Fed continues to tighten. But what doesn't make a lot of sense is even though employers say they're desperate for employees, well, they're actually laying off. And here we can see this week's unemployment claims. And while these numbers aren't here huge, 260,000 people were sent to the unemployment line last week, suggesting that perhaps employers are already finding out that demand is going down, and all this government data that we're seeing is really lagging the truth. Of course, we already know that, suggesting that perhaps indeed we are facing an imminent recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. I appreciate you. But we'll see you soon. Bye now. The content of this video provides educational information only. It's not intended to provide investment or other advice. It will not to be construed as recognition or solicitation to buy or sell a security, financial instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre personal capacity. The opinions expressed in this video that do not reflect the view of Atlas Financial Advice Inc. or Steven Van Metre Financial.